The market's almost rotated for the last, call it 2 weeks, 2.5 weeks, and now we've broken back below that 1221, and you can see that's the day we're looking at, which is the 2nd of August. Okay, so we're looking at that breakout point of that 1221 on the footprint. Let's get into it now. Let's get the footprint up and see what happened. Okay, so the first thing we're looking at is the break of 1221. Now, I just want to zoom this forward. So yeah, we have it. Okay, here's the 1221. The blue line annotates that break point, and I'm just going to zoom this out a little bit. All right, now this is how we develop our actual versus expected. All right, we had expectations: high volume, high volatility, and we only want to see selling, no buying. Okay, so we go and look at it. We say, okay, the market, effectively just before that level, we can see the imbalance. Okay, so note there, we got the 42 by 0, the 80 by 0, the 105 by 15. Straight away, that's what we want to see. Okay, so confirmed. We're seeing sellers interact in a way that they're becoming aggressive. They're not waiting for buyers. They're just hitting the market. Okay, and that's our first little clue that, yes, what we expected is occurring. We then break and we snap. Okay, now straight away on the snap, what you can see at the bottom here is you can see 80 by 8, 136 by 0. Okay, when we see that on the footprint, that is stops in the market. Okay, so someone that was long just simply hit into the best offer, the best bid, and ultimately got filled at that best bid, but there was no counter bid. Now that's why we've got a 0 and an 8. No one was willing to buy the market, so it was simply just a stop run to the downside. All right, so straight away we can see, all right, this looks, this is following everything we expect. We see the pickup in volume, all right, we almost triple the amount of volume or quadruple the amount of volume, and we see the delta go negative. So straight away, even the volatility, notice the pickup in the volatility of the candle. Right, probably if you zoom this out a little bit, you'll see it's one of the widest candles over almost a couple of hours. So we've met our expectation. Volume has picked up, volatility has picked up, and the interaction is what we expect, i.e. sellers becoming aggressive, stop outs, and ultimately, no one really buying the market up. That's our first, sort of expectations met. Let's see what happens now as we go on, and this is where the footprint is so wonderful. Okay, notice what we see in the next rotation. Look how darkly colored this is. Now again, if you follow a lot of footprints, this is what you're looking at. Look at what's trading ultimately here. We're almost done 3,000 contracts. Okay, every one of these obviously is a 5-minute rotation, guys. So we've done 3,500 contracts, but what's price doing? Okay, yeah, simply price is not moving at all. So 3,500 contracts, a lot of selling, but price is not getting anywhere. And we move on to the next one, another 1,000 contracts, price still not moving. And another 3,200 contracts, price has not changed. So for 15 minutes, we've done almost 8,000 contracts below a key point, and we haven't moved price. We haven't changed price. And that's the first clue. That's telling you something, all right? If you go look at every single breakout over the last, your last 10 breakouts, and you look at it in this way, you're going to very quickly identify most good breakouts do not hang around for 20, 25 minutes before continuing. Okay, no ways. Maybe 5-6 minutes and then continue on, or maybe even 1 minute and then continue, accelerating to the downside. And that's the real key. That's the nuance. That's the shift. Yeah, that's the what I expected is not playing out. It's not actually playing out. All I'm seeing, someone is selling. Yes, those sellers are there. Those big time frame players are there, but someone is buying. Okay, and that's the real clue. That's the oh my goodness, what's going on here? And that's what struck me about this gold, was that breakout was particularly interesting because it was met with so much buying. Now I note that down. I observe that. I say, okay, well, this wasn't a clean break. There was someone buying the market up. So eventually we're going to scroll on. It gets to 7 o'clock at night, and we can see that buying is finished. All right. How do we know that? Well, we can see the market then starts to offer down. All right, so we move from that 1221, and note, guys, never retested the 1221, never got above it. We then continued low all the way down to the 1216. Okay, so a good $5 continuation. The important thing, however, is this, and this is what's important to remember. We should have seen that $5 continuation, I don't want to say instantaneously, but I would have thought based on expectation within the next half hour. Okay, we only saw it almost 2-3 hours later. And that's the real key. That's something's not quite fitting my expectation on this breakdown. Okay, so now let's move on and talk a little bit about what had happened going into that break, because I want to show you guys a little bit of something going into this break. That's very, very interesting. Okay, now had you been trading this, I put out a tweet saying, there's a very strong signal or buying signal coming into the market. Now I'm going to show you something that was very interesting in this gold. Again, same day, 2nd of August, but go back to 1 o'clock in the afternoon. Right? I put out a tweet saying I want to watch this 1221 because it feels like someone is ultimately looking to take the stops at 1221 and then buy the hell out of it. Okay, and I'm going to show you what the buy the hell of it looks like. So we came down at 12. Notice the absorption. Right? Market moves sideways. Now watch what happens as the market goes bid. So we've come into this low. The market starts to go bid back up. Right? Have a look what happens on every rotation. So the market bids up, and then what do we get sitting here? Right, we get quite a lot of two-way trade. In other words, buyer buying high prices, but also seller selling or accepting that buying. The market then rotates higher again. What do we get? Okay, so now markets moved higher, prices moved higher. Buyers now continuously buying a lot of volume at higher prices, right? But the seller's still giving it to him. And we see it again. And we see it again. And in essence, what's happening here is that the market's moving higher in terms of price. The buyer's willing to buy higher and higher, but the seller's still willing to sell higher and higher. Now, the point of this and why you watch this is because at some point, when we reach a certain price threshold, right, one of these two have to give up. Because what's happening now is that the buyer's buying higher and higher prices, being more intentional, but the seller's also willing to give them to him at higher and higher prices. And this is all done in volume. Remember, you never want to look at these situations, any situations, in low volume conditions. Okay, why? Because that can be created by an algorithm. When big time frame players are playing, when volume is being done, right, you always want to observe what's happening. Always, okay, because that's inventory, that's stock, that's physical transactions that are occurring. That's two big boys that are playing with each other, and one of them is going to win. Right? And we can see that high volume. Notice the dark colors. Right? If it was low volume, I'll just scroll back and show you. Okay, if it was low volume, it would look like this. Okay, lots of light little colors, nothing more than 1,000 contracts traded. This instance, look what we're doing: 2,000, 3,000. Okay, no data, nothing out, just a lot of interaction, a lot of business being done in the gold market. Now, eventually, the market comes, the sellers start to stop out, they start giving up, the buyers becomes more intentional, the market rushes up to the top side, and then it's finished. Okay. What's interesting, if you look at the next rotation, right, is that the sellers began to get very aggressive at this 1226.9. But what did they sell into? And again, look at this chunky volume, 3,200 contracts. These sellers were selling so aggressively, but look what they were selling into. Some very aggressive buys. Okay. Now, when you see this, write this down somewhere. If ever you want to be a good trader, when buyers and sellers interact in volume, those points in the market at which we turn are crucial. Absolutely crucial. That 1226.9 in the gold market becomes the single most important level now for anyone short. If 1226.9 goes at any point in the next couple of sessions, you want to be aggressively playing for a breakout, for the end of this, large time frame sell-off that we've, effectively had. 1226.9 is the key, guys. Okay. Why? Because we can see how much a defense was put up by the sellers. More importantly, those sellers got a grip, took the market all the way back to that 1221, which is the area we were talking about earlier, stopped through it, and ultimately continued lower. Okay, write that down, 1226.9 and 1221. Now, let's fast forward and go to non-farm payrolls. Okay, because I want to talk about the non-farm payrolls. That was obviously the 3rd of August, and I just want to get to the non-farm payrolls and show you guys the reaction off of the low. Okay, so we can see now, and again, let me just quickly get the, let's bring you up to speed with regards to the chart. I just want to show you the 30-minute chart now. So you can see, obviously, that was the break of 1221. That's our key level we're talking about. We can see the continual drift the night before. Market entered sideways territory, continued to drift lower. Now, 1221 becomes an important pivot for two reasons. One, we obviously saw there was a lot of defense there, a lot of volume traded there, both buying and selling. Okay, and the second thing is, we want to see ultimately, if the market respects that level and is unable to trade above it. Now, the first thing you can see, and we're going to talk about this when we get to the footprint, notice how the market did respect it. Traded straight up to it after non-farm payrolls, backed off from 12.21 all the way down to 12.18s, a good $3 move. But once it took it out, look what happens. Okay, what do you see? Highest volume traded almost the entire session once we took that 12.21. And that's important, guys. That's so significant, because what it's telling you is that is where the positioning was. That is where the stops were. Okay, so what you have to do is you have to go back now and think in your head, okay, so yesterday, being Wednesday the 2nd of August, we had sellers that ultimately 1226.9, I'm going to put that area, 1226.9, I'm going to put it in. Right, so 1226.9, we saw some very aggressive selling entering the market, positioning. Right, we saw more positioning at 1221. The market continued lower. Then you go and you say, okay, well, we got back to that 12.29. We saw some of that positioning unwind. We got back to that 12.26.9, okay, and we managed to see the market hold on to that area. So we can see 12.26.9, yes, poked above it. Notice the volume shift, big pickup in volume, but ultimately it got defended, it got protected. So what's the positioning in the market? Right, if you go over the course of the last 2 days, well, we've probably entered a little bit more of a neutral positioning now. In other words, right now, the market's neither long nor short. It's taken out the stops at 12.21. If we get above 12.28.5, watch out. Okay, you should see a lot of buyers enter, a lot of anyone else short take profit. Equally, we could very easily move back towards the 12.12 low. Let's go to the footprint now. Let's have a look at how that low was made on the footprint. So, and again, I talk very often on footprint. If you want to get good at this tool, guys, you've got to learn to look at it every day. Look at how the lows and highs are made. Look at all these interactions. Now, this is beautiful. This low made on non-farm payrolls Friday on the 3rd of August is beautiful, and I'll show you why. So the market comes into the low. Okay, pick up in volume. Notice what was happening before. Okay, no volume traded, almost a good hour before. At 9 o'clock in the morning, a little bit of a pickup in volume. But what's it met by? Okay, in trading terms and candle terms, we call this an equal and opposite. In other words, we have a full-bodied candle. We can see that it opened at pretty much the high of the candle, closed at the low, and that's with these color bars on the left. And we see an absolute reversal in the very next rotation. Okay, so an equal and opposite. Equally, we see high volume, but we also see the delta. So we see sellers initiate aggressively and buyers reverse and aggressively initiate. Okay, we call this a V reversal. If you've ever been watching me for the last couple of years, this is what a V reversal looks like on the footprint chart. Now, V reversals effectively tell us that we got an initiation by the sellers in the initial move, and then we get initiation from the buyers. Now, when you see V reversals, they do tend to hold as very strong, price action signals. Now, why this is important is because, like I said to you, this low now becomes quite significant going forward. Right? If we take out that low, again, we've got a little bit of buying here position. We should continue with the trend to the downside. Now, let's move on and let's look how the non-farm payrolls reacted. Okay, so number, again, not all too important, the number. In essence, it did come out a little bit weaker in terms of the earnings growth, but nothing significant. Okay, so here's the number. Market bids up. Okay, nice bid up. Sorry guys, my footprint is doing some crazy things here. Just give it 1 second to load. Come on. Okay, there we go. Okay, so we can see on the left side of the screen, this is the non-farm payrolls. Okay, again, we're not too interested in what happens over non-farm payrolls. It doesn't mean anything. So again, if you're going to use a footprint, always exclude certain economic data. Why? Because this is all fast money. This is algorithms squaring up, all sorts of crazy stuff. Now, the first thing I want to do is I want to go and look how, we tested that 1226.9. That for me is a very interesting area. Okay, so watch what happens. Market comes up to the 1226. Notice the volume. Okay, so there would have been a little bit of stopping out there, but equally we can see a lot of positioning there. Look at this chunky volume. So the day before, remember, the day before, that's where we saw those sellers very aggressively defend the position. What do we see here again? Okay, look at that. Almost 10,000 contracts traded again at that 1226.9. It is a significant area. Now, a lot of you going, yes, but it traded through. Trading's not about single prices, guys. All right, unfortunately, you don't see a guy at Goldman Sachs going, well, I'm going to trade everything in gold at 1226.9. It doesn't work like that, right? It's ranges, it's price areas, right? So we can see 10,000, even more. If we go, within this range, we can see within a dollar and a half range, we almost did 25,000 contracts. That is the defense. That is the sellers entering. That is the sellers holding their positions. Look at that. And that holds for almost a half an hour. What happens? The buying finishes and the market begins to drift lower. Okay. What's the point of all this? Well, why am I showing this? Well, it's very simple, guys. What I've just shown you is three different pieces of interaction. Number one, okay, we saw the interaction when we broke out below 1221. That was where the stop should have occurred, and we saw how weak that was. Number two, when we then came back above the 1221, we saw how aggressive the stops were. Okay. Number three, we saw how the 1226.9, a massively significant area in price action on the Thursday, became significantly important on the Friday. So what that means, and this is why when we talk about, I'm just going to go back to the slides. When we talk about over the next couple of slides, about the execution methodology, right, what does it all mean? Well, there is a play at hand here now. Okay, we've got a very significant area at 1228.5. Why? Because of all that positioning from the sellers. But equally, we've got a nice V reversal from that low. So if we get below here, we should continue low. If we get above here, we should continue higher. Right? Everything in between is relatively neutral. Notice what I've done there. I brought you back to that concept of expected versus actual. If we get to that 1228.5, I expect to see a stop run. I expect to see it very aggressive to the upside. If we get back down towards the 1210, well, I probably expect to see a little bit more of the slow drift lower. Yes, it's going to continue lower, but it's not going to be as aggressive. Why? Because the positioning just isn't there from the longs at the moment. And that's the purpose of building an expected versus actual.